The world is a complex system. It has many moving parts. One of the biggest parts is how we measure wealth. For thousands of years, two things have competed for this role. One is money, the other is gold. This is not a new fight. It is an ancient war of ideas. What is real value? Is it the paper that governments print, or is it the heavy yellow metal that comes from the earth? Understanding this conflict is more important today than ever before. Our economic future depends on it. We must look closely at both sides to see the truth. Money, as we know it today, is a promise. It is often called fiat currency. Fiat is a Latin word. It means let it be done. A government simply declares that a piece of paper is worth something. For example, the US dollar is valuable because the US government says it is. We trust this promise. We use this paper to buy food, pay for our homes, and run our businesses. It is a system built on collective belief. If that belief falters, the entire structure can shake. This is the great weakness of modern money. It is only as strong as our faith in the people who print it. Gold is different. It is not based on a promise from a government. Gold is a physical element. It has its own value. You can hold it in your hand. It does not rust or decay. Its supply is limited. You cannot simply print more gold when you need it. This scarcity gives it a powerful intrinsic worth. For centuries, kings and empires hoarded gold. They knew it was real wealth. It was the ultimate store of value, a tangible asset that survived wars, plagues, and the collapse of civilizations. It did not need a government's blessing to be precious. This fundamental difference is the heart of the debate. Money is a tool of policy. Governments can control its supply. They can use it to stimulate an economy or to pay for wars. Gold is a tool of discipline. It acts as an anchor. It prevents governments from spending recklessly. It forces them to be honest about the value of their currency. When a currency was backed by gold, its value was stable and predictable. Today, most currencies are not. They float freely, their values rising and falling on the tides of global politics and economic policy. This creates uncertainty and risk for all of us. Money is the king of our daily lives. We cannot escape it. Think about your morning. You bought coffee, you used money, you put fuel in your car, you used money again. It is the blood that flows through the veins of our modern economy. Its main purpose is to make transactions easy. Imagine a world without it. You would have to trade things directly. This is called barter. If you were a baker, you would have to find a farmer who wanted bread in exchange for milk. This is very inefficient. Money solves this problem perfectly. The practicality of money is its greatest strength. It is portable and divisible. You can carry it in your pocket or access it digitally with a card. You can break it down into smaller units like dollars and cents to pay for things of different values. You can buy a pack of gum or a new car with the same type of currency. Gold cannot do this. You cannot easily shave off a tiny piece of a gold coin to buy a loaf of bread. This is why, for everyday commerce, fiat money reigns supreme. It is designed for speed and convenience, fitting seamlessly into the fast pace of modern life. Furthermore, money is a unit of account. This is a fancy way of saying it gives us a common language for value. We can price everything in dollars, euros, or yen. A house costs a certain number of dollars. A salary is paid in a certain number of dollars per year. This allows us to compare the value of different goods and services easily. It helps us make budgets and plan for the future. Without this common measure, economic calculation would be nearly impossible. Our entire financial system, from local banking to global trade, is built upon this simple but powerful idea. However, this convenience comes at a cost. The value of money is not constant. Central banks, like the Federal Reserve in the United States, have a mandate to manage the money supply. They can increase it to fight a recession or decrease it to control inflation. This means the dollar you have today may not buy as much tomorrow. This slow erosion of purchasing power is a hidden tax on your savings. While money is an excellent tool for spending, it can be a poor tool for saving over the long term. Its value is constantly being manipulated by policymakers, creating a silent risk for everyone who holds it. Gold plays a very different role. It is not for buying coffee, it is for preserving wealth. Gold is often called a safe haven asset. When people become nervous about the economy, they turn to gold. They do this when they fear inflation, they do it when they see political instability, or they do it when stock markets are crashing. Gold acts like an insurance policy for your portfolio. It is a silent guardian that holds its value when other assets are losing theirs. It does not pay interest or dividends. Its power comes from its stability in times of chaos. The historical record proves this point. For thousands of years across every continent, gold has been recognized as a store of value. The Roman Empire used gold coins. The Spanish Empire sailed across oceans for it. When a country's currency collapses, like in Zimbabwe in 2008, or Venezuela more recently, people rush to buy gold. They know that a worthless piece of paper cannot buy food, but a small amount of gold can. It is a universal currency that needs no government to back it. Its value is understood everywhere, making it the ultimate financial backstop when trust in traditional systems breaks down. As an investment, gold behaves differently from stocks and bonds. Usually when stocks go down, gold goes up. This is called an inverse correlation. It makes gold a very useful tool for diversification. A diversified portfolio is one that holds many different types of assets. This reduces your overall risk. If one part of your portfolio is performing poorly, another part may be performing well, balancing things out, including a small allocation of gold, perhaps 5 to 10% of your total investments, can help protect your wealth from the unpredictable swings of the financial markets. However, owning gold is not without its challenges. It can be difficult to store safely. You might need a secure safe at home or pay for storage in a vault. Buying and selling physical gold also involves transaction costs that are higher than trading stocks online. And while gold is stable, its price can be volatile in the short term. It does not generate cash flow, so its returns come only from price appreciation. It is not a get-rich-quick scheme. It is a long-term strategy for wealth preservation against the biggest risks in the financial system. So, which is better, money or gold? The answer is not simple. It is not an either-or choice. The truth is you need both. They serve different purposes. Money is for today, gold is for tomorrow. Money is for spending, gold is for saving. Thinking of them as enemies in a war is the wrong approach. It is better to see them as two different tools in your financial toolbox. A skilled craftsman knows which tool to use for which job. A wise investor knows how to use both money and gold to build and protect their wealth. In today's world, we face huge economic challenges. Governments around the globe have printed trillions of dollars to deal with crises. This has created massive amounts of debt. It also raises the risk of high inflation in the future. In this environment, relying only on fiat money is dangerous. Your cash savings could lose their value quickly. This is where gold becomes essential. It provides a defense against currency debasement. It is a way to anchor a portion of your wealth to something real and tangible, something outside the control of politicians and central bankers. A practical approach for the average person is to use a balanced strategy. Keep enough cash and digital money on hand for your daily expenses and for an emergency fund. This gives you liquidity and convenience. But for your long-term savings, the portion of your wealth you want to protect for years or even decades, consider allocating some of it to physical gold. This does not mean you should sell everything and buy gold coins. It means you should understand the risks of holding only paper assets and take steps to diversify. Ultimately, the debate between money and gold is a debate about trust. Do you trust that governments will always manage the currency responsibly? Or do you trust in an asset that has held its value for 5,000 years? History shows that all fiat currencies eventually fail. It may not happen tomorrow, but the risk is always there. Gold is the ultimate insurance against that risk. In an uncertain world, Having a small piece of this timeless silent guardian is not just a financial strategy, it is common sense. It is a way to secure your financial future a little more firmly.